Hello, and welcome to Root Access, the show for startups on Google Developers Live. I'm Martin Omander, and I'm joined here by legendary investor and Googler, Don Dodge.
Right.
Welcome, Don. Today we're going to talk about Demo Day season, 500 startups and YCombinator, two of the most well-known accelerators, just had their demo days. And I know, Dawn, that you attended both of them. What trends did you notice in the demos this year?
More conservative, more business focused. In years past, you saw lots of consumer-oriented companies, social kinds of applications, and lots of mobile apps. This year, it was more focused on business, more conservative. Some might say boring kinds of ideas, but they make money. So all of them, you could clearly understand the business model. You could connect the dots from where they are to $1 million or so of revenue, and more focused on business as the customer.
I see. Was that a difference between 500 startups and YCombinator, or what was the difference you noticed?
No, both of them were more business focused than in the past. I think the difference I saw at 500 startups was a more international flavor. So 500 startups had about 32 companies, 35 companies, and I would guess that half of them were from countries all over the world. So a much more international flavor. From the founders, and even the business ideas were things that you wouldn't normally think of as being a business opportunity in the US. They were focused on those sorts of things and generating revenue pretty quickly. YCombinator was more Silicon Valley focused. The founders all seemed to come from Silicon Valley or the other tech hubs. But again, more business focused and that kind of thing.
Right, yeah, I noticed that the YCombinator, a lot of those startups were, while they were still in the Accelerator program, were cash flow positive already. What's up with that?
Well, I think when you're focused on a business-to-business kind of company, you're selling to business. Businesses are more accustomed to paying money for things, as opposed to consumer-oriented companies where you're either generating revenue based on advertising or on a subscription freemium kind of thing where it starts out free and you pay money later. Those consumer web app kind of social businesses take longer to generate revenue, whereas business to business type companies generate revenue very early. So many of the companies at YCombinator, they're launching on stage and already talking about revenue streams that they have in place. So I think that's the major difference.
I see. How does all this play into valuations? Are the valuations higher, lower, the same as previous years?
More reasonable, I would say.
Reasonable, that's good.
In the past couple of years, we were in a bubble where companies just launching at YCombinator were having valuations in the $8 to $12 million range. That's pretty rich for a company with 3 or 4 founders and just launching with negligible revenue to have $8 to $12 million valuations. This year, I think we saw the valuations come down to more reasonable levels, like in the 7 to 10 million range. So that's still pretty rich, but down from years, the past 2 years, and a bit more reasonable.
Ah, right. Are these Silicon Valley bubble valuations? How are valuations in Boston, Austin, New York, other places?
I think the valuations in other locations are lower, so say more in the 4 to 7 million range than the 7 to 10 million dollar range that you see in Silicon Valley. There are, of course, exceptions to that. Great companies can start anywhere and command very high valuations, but in general, Silicon Valley investors are more accustomed to paying up and paying higher valuations than in other parts of the country or other parts of the world.
So does that mean that the good deals are outside Silicon Valley?
Well, it depends on how you talk about good deals. If you're talking about valuation, yes, valuations are lower in other parts of the country or outside of the US. But from an investor perspective, a lot of times valuation doesn't matter. Because if a company hits it big and goes to $800 million valuation, it really doesn't matter if you paid $5 million or $8 million on the first investment. Conversely, if the company fails, you lose 100% of your money anyway. So it doesn't matter if you put your money in it at 3 million or 8 million. If you lose it all, you lose it all. So I think Silicon Valley investors in general are less valuation sensitive and look more at what is the upside, because they know going in they're going to lose half of their money anyway, or meaning half of the investments they make will be total wipeouts.
Yep.
And the other half, one of them hopefully will be that 800 million or $1 billion company, and that pays for all the mistakes.
Ah, I see. That's quite a bit different way of managing money than I manage my 401k, I can tell you that.
Me too.
Good, good. That's all for today. Please leave your comments on the YouTube video and questions, and we'll try to get back to them in future episodes. Thank you for joining us, and see you next week. Bye.